Okay, great. Welcome to today's webinar. My name is Raman Gill, and in today's session, um, again, like I said, my name is Raman Gill. I'm the founder of the website tradingwithvenus.com. Just a quick disclaimer before we get started. This is for educational purposes only. I'm not a registered investment advisor. So if you have any questions about your individual investment needs, please go see an investment advisor. So in today's live training, we will take a look at Fibonacci. I know a lot of people have heard about Fibonacci. It's one of those things that we hear about all the time. However, I have found that not everybody necessarily knows how to use the Fibonacci's properly, or, they're very ambiguous. It's not like pivot points where you have mathematically calculated levels that you place them at. This is very ambiguous, which means you can draw them from wherever you like. You can draw them in multiple different ways. There can be different swing levels that you can draw them from. And I know when I first started trading, I learned about Fibonacci's. However, I wasn't doing them properly. And because of that, I kind of had moved away from that. However, over the years, I have found the Fibonacci's to be good levels. So something that I keep in my toolbox, and I use them as one of the things that when I trade, I use them as a confluence factor. So we will also look at how to make your technical analysis more powerful using Fibonacci sequence. Just like I said, they are one of the things that I use when I trade. And how to identify trade entries and potential profit targets with greater accuracy. That's really what we'll look at, so that you're actually becoming, so you can become more profitable in your Forex trading. We will also take a look at how to create a trading plan where you're using Fibonacci retracement and extension levels together, coupled with your other technical analysis tools that you may be using. All right, so let's dive in. So first, just a brief overview of who I am and why I'm doing this. So my name is Raman Gill. Like I mentioned before, I am a full-time Forex trader. I have been trading in the markets trading live for over 7 years now. My educational backgrounds, I have a couple of MBA degrees, one from Cornell University in the US and another one from Queen's University here in Canada. My background prior to trading was in computer systems. I did, in IT. I have been doing IT for the last 15 years or so. In terms of where I have worked in the past, my working history is I have worked in the financial industry for a number of years. I've done mergers and acquisitions. I have done other roles in the financial services industry. And prior to doing the banking industry, I had my own business. I ran my own business for 10 years. It was an IT consulting business. So that's kind of my work history there. In terms of my personal stuff, I am married. I have 2 kids, so family. So the trading seems to fit in nicely with my other responsibilities that I have in life. And in terms of one of the things that I always say is, if you are looking to become a trader, or if you're interested in this field, one of the things I always suggest taking a look at is, why do you want to do this? And for example, let's say everybody wants to be a top athlete. We watch sports on TV, and we see how much the top athletes get paid. And I think it's every child's dream to become a top athlete and make millions of dollars. However, the question there is, it's nice to have that dream. However, you have to ask yourself, do you have the passion for doing that? And the reason you need to have a passion is, one, money is great, but in terms of passion, it takes hard work to get to that level where you're making sufficient money or lots of money, and it's not an overnight thing. It certainly wasn't for me. I won't say that I was able to just wake up one day. I took a weekend course and I started making lots of money. It does not work that way. And also, in terms of making millions of dollars, you have to have a large enough account size to be able to make millions of dollars. However, having said that, it is still a very good career option for a lot of people. Your returns that you get in this type of environment, if you take it seriously, can be quite lucrative. And you can also, the most important thing is you can create the lifestyle that you want. And that's what attracts me to this. I'm big on freedom, having the freedom to choose what I want to do, when I want to do it, and how I want to do it. And this seems to work really well for that sort of person. So if you are a person who wants any of those things, this is a great opportunity. However, if you are only looking at the money that you can make, then I have to say that there's a lot of downside as well. I have blown several accounts in the past, and it is so very easy to blow an account because a lot of times people just look at the potential benefits and forget that what would happen when things start going wrong. So be mindful of that. It's not just a one-way street. There are losing trades, and how you manage your trades and risk management becomes very important. So just that question, ask yourself, why do you want to trade? And if passion is one of them, if you can talk about trading all day long like me, then I would say this is a good career opportunity for you. All right. So for anyone who's new to Forex, I'll just go through one slide of what Forex is and why it's a good field to be in. So first of all, it's the largest traded market. So every day we have about close to about $5 trillion that exchange hands on every single day. And if you compare this to New York Stock Exchange, for example, which is one of the largest exchanges or stock equity markets out there, you would see that it's only $50 billion. So comparing that to 5 trillion, 4 to 5 trillion, which is the current number for Forex market, it's quite sizable compared to any equities markets. And then there is high liquidity in this market, which means when you go to place your order, a lot of times you don't have to wait 2 days or 3 days for your order to get filled. It will get filled right away because there's always somebody on the other side of the trade, somebody wanting to do that trade with you. So there's high liquidity in the market, whether that's financial institutions being involved who are doing transactions on behalf of their clients, or some mergers and acquisitions activity coming on, or just retail traders, or maybe large hedge funds or other people who may be involved in this market. So there's always buy and sell orders in the market. And actually, sometimes you'll see when we have huge moves, like sudden moves, like you see after the news, that happens because the orders get removed from the market. So price drops or goes up looking for those orders. And because market is expected to be volatile at that level, big funds and financial institutions will actually remove their orders ahead of that. Or move them out. And that's why we see those huge gaps or inefficient moves in the market. All right, so also leverage is very important reason for getting involved in this market. For example, if you are looking to trade stocks, you need to have a number or a large account size. For example, let's say one of the bank stocks, for example, let's say they're trading at $100 for one share. If you only have $1,000, you can only buy 10 shares, and then your money is locked in that. So you have to wait for the price to go up, and that could take 5 days, it could take 10 days, or it could take an hour. So we don't know that. And so you have to wait through that time period for you to be able to find, be able to sell and make profit in that. However, with Forex, what you can do is, and you can use leverage actually, even in other type of markets, but in the Forex market, what I find is that you can have a small account size. You can still have your $1,000, but your brokers will give you leverage, so you can get 50 to 1 or 100 to 1, or some brokers, offshore brokers, will actually give you more than 100 to 1 leverage, which means that with your $1,000 you can control a much larger trade size, and you can actually, your profits will be proportionate to the size of the trade that you're taking on. So I do not recommend using a $1,000 account to trade full lots, because that's a recipe for disaster. You're not managing your risk at that point. However, it is a good way to get started in this market and start seeing some results based on your $1,000, which you won't be able to see in a lot of the markets. And then once again, it's open 24 hours a day. There are 3 different distinct sessions that you can trade, or you can find a time that suits you when there is enough liquidity in the market, and you can take trades around that so it can fit into your lifestyle. All right, so let's get into today's topic then, which is Fibonacci sequence, Fibonacci retracements, and extensions. So Fibonacci numbers were discovered by an Italian mathematician called Leonardo Fibonacci. This is a sequence that's actually found in nature. So if you look at different things, for example, even things like the shell, the snail shell, or any of the seashells where you find it's a round shell, its sequence, the number of the rings in there will be based on Fibonacci sequence. And even things like mountains, the ratio, the way the mountains are positioned compared to the sea level, that's also based on Fibonacci ratios. If you look at trees in the forest, you will see the trees, the placement of the trees and the height will be based on Fibonacci sequence as well. So this is something that's just nature provides. It's not something that's man-made. It's just natural. And you'll find, in terms of even human beings, people that we find or think of as attractive are actually have ratios, the Fibonacci ratios, the placement of the eyes, for example, and nose compared to the size of the face will be based on Fibonacci ratios, which is actually quite interesting if you think about it. So from mathematical formula sense, it's a series of numbers. So it's really a pattern, and the pattern is formed by, and the numbers, so if you want to look at it, 0, 1, 1, 2, 3, 5, 8, these are the numbers in the series. And the way the numbers are formed is you add the first number with the second number to derive the next one. So 0 plus 1 is 1. So 1 is the next number in the sequence. 1 plus 1 is 2. So that's the next number in the sequence. 2 plus 1 is 3, which is the next number in the sequence. And you can keep on going like that. So 89 would be a combination of 34 and 55, for example. 144 is, if you add 89 plus 55, you'll get 144. So that's how the series is derived. And then we have another thing that we actually use in our trading are the ratios. So basically, ratios we derive by dividing any number to the next number higher up. So for example, and that's where we get the 61.618 or 61.8%. For example, if you were to divide 34 by 55, you will get 6.618 or 61.8%. Ratio is what you will get. So any number, if you take the two numbers and if you divide the first number by the next number in the series, you will get this number, 0.618. That's your ratio. And this ratio is called the golden mean. And it doesn't matter which number it is. So if you divide 3 by 5, you will get 0.618. If you divide 5 by 8, you will get 0.618. And so this is called the golden mean, and this is what's found throughout the nature. Now, we also have other ratios that are important, like 0.382 or 23.236. So these numbers, so the 0.32 ratio is if you divide 34 by 89. So if you skip one number, so if you skip 35, so if you divide 34 by 89, you will get 0.382. And if you skip two numbers, if you divide 21 by 89, you'll get 0.236. So the good thing is that we don't need to do these calculations. This is just a brief overview of how the numbers are derived, so you have an understanding of them. However, we don't need to do any of these calculations because they are done automatically for us. So let's take a look at what are the Fibonacci retracement levels. So when you draw your Fibonacci retracement tool, these are the different numbers that you will be able to find. So you'll see 0.236, which is 23.6% retracement, 0.382, which is 38.2% retracement, then 50% retracement, 61.8% retracement, and 76.4% retracement. So there are a number of different levels like this. These are some of them, and you can have 78.9, 88.6. So these are all the different levels that you can, ratios or levels you can look for potential trades. And the way most traders use Fibonacci retracement levels are as potential support and resistance areas, which means we are looking for trade setups at these levels. A lot of times you will find these levels will come into play, and that's where the price tends to retrace or come into resistance, and it will start going the other way. So that's how we are using it, and we'll go into a little bit more detail around how you can do that. And important thing about these numbers is that, or fib levels, is that a lot of traders watch these levels. Because many traders watch these levels, they become a self-fulfilling prophecy, because these levels are watched, people will place buy and sell orders around them. And even a lot of the algorithms, that automatic trading algorithms that are out in the markets, will respect these levels. So they will watch for these levels, for trade setups in these levels. And because of that, because of the computer systems or trading systems built around them, a lot of even the professional traders, in the institutional traders, will look for these levels. And because of that, they become a self-fulfilling prophecy, so that when the price does come to these levels, it tends to have a reaction at these levels. All right, so Fibonacci extension levels is, so the retracement level is the pullback. So let's say we had the first move, and the pullback from that move is called the retracement levels. And the extension level is when the price goes, we have the pullback and the price goes beyond the 0% or the 100% level. And we are basically looking for, after the pullback, where does the price go to? So these are some of the levels. These are the same as the retracement levels, and extension tool has these, just so that we know where the price is retracing or pulling back to. And then 38.2, 1.382, 61.8, these are all extension levels. These will be used as targets, potential targets for our trading. All right, so again, because these everybody's looking at these levels, they become self-fulfilling prophecy, just like the retracement levels. Okay, so Fibonacci tool, I have found that it works best when the market is trending. If it's a range-bound market, it's not, you have a range, you have a high and a low, and the price tends to trade within that. There really isn't, this is not the best tool suited for that market. However, when it comes to trending market, you see that price comes and respects these levels. So that's the best time to use this. And in order to use Fibonacci levels, you're basically looking for a swing high and a swing low. So what do we mean by that? A swing high is a candlestick or a place where you have at least two lower highs on both the left and the right. So you'll have a candlestick and you'll have a high and a low. So let me see if I can actually draw it here. Here. So let's see. So you have a candlestick here. Just gonna move this out of the way, and then you have next candlestick that's lower to the left, to the right, and another candlestick that's lower to the left. So this will be your swing high. And same thing for swing low. You have a candlestick in the middle, and then you have a candlestick to the left that is higher, and another one on this side. So this is your swing low, and this will be your swing high. So basically, in drawing our fibs, we are going from swing high to swing low. Okay, so let's clear that. So here's an example. So we have a swing low where the candlestick is, in this case, is at the same side, same level. It opened where it closed, it opened. But if you look at the next two candlesticks, they are higher. So this is our swing low, and this is our swing high, where we have the middle candlestick. Oops. We have the middle candlestick, and then the ones to the either side are at a different level. They're not at the same level, or they're not higher. They're both lower. So that would be our swing high. So we would draw our swings in an uptrend when the market is going up. We would draw it from the bottom swing low to the swing high. And when the market is coming down, we would draw it from our swing high to swing low. So let's take a look at a chart example. So this here is a 4-hour chart. This is just most recent price action. This was Friday, yes. So this is a 4-hour chart, pound US dollar 4-hour chart. I have marked my support and resistance levels. I tend to mark my support and resistance levels all the time. So we'll leave those on. So this is how we draw. Oh, actually, I should backtrack here. So this little F here is your Fibonacci retracement tool. So this is, so you click on this button here, and then you take your level from top to high. So you push it down and pull it all the way from swing high to swing low. And that's how you draw your Fibonacci. And if you take a look at on the right hand side here, you will see I have 100%, 78.9, 61.8, 50. All these are all the different retracement levels. And then I've also marked my extension levels here. I like to use, instead of using this Fibonacci retracement and extension, I like to have my levels on the same tool. And if I could quickly show you how to do that. So you double click on your indicator, and then you right click, you go to Fib or Fiber properties here. These are the different levels. Normally on the retracement tool, you will just have these ones, and you can add your extension levels here. So you just click on add, and then you can put these numbers in. So let me see if I am missing anything. So you have, so you can just click and add here. So let's say you wanted to add retracement level 0. Let's say 88.6. You can just do that, and here just give it, this is a description. This doesn't really make much of a difference. You can put anything you like. I like to put my actual numbers here. So click on add and say okay, and as you can see, that level showed up here. So that's how you can add different levels here, and you can add your extension levels. As you can see, I have this 161.8, 127, and then you'll see my 200 level. So these are the projections that we are doing based on the fibs projections into the future price movement, essentially. So that's how you draw your fibs. Any questions around so far? All right, so let's carry on. So So how do the fibs work? So basically, we are looking for, so once we have drawn our fibs from the high to the low, for example, in this example, it's a downtrending market. So we know we have a trend in place. So the first thing you want to look at is there a trend in place? That's the first question you want to ask. So if the answer is yes, then you can look at your daily chart, for example, or a 4-hour chart and find a clear swing level, swing high and a swing low, and you draw your fibs. So basically what you're looking for is price never moves in a straight line. So there will never be a straight drop. Um, Although at news you can see that, but in general, price won't just drop. There will be pullbacks and retracements. So you're looking for a pullback level, and these are the different levels you have drawn. So you're looking for any of these levels to show you a signal, so show you a rejection at these levels. That's what we're looking for. We don't just blindly enter into trades at this level. We're looking for a rejection of these levels to get into a trade entry. So here, as we can see, the price came to 50% fib level, which is 50% retracement. And this level, this is a 4-hour chart. So this level, this is a nice pin bar on the top, which shows a rejection. So if you were to go to your 5-minute chart or your 15-minute chart, you will find that there will be either a double top type of pattern here, or some sort of a pin bar reversal, or some sort of a rejection pattern, a reversal pattern that you'll find on this chart when you drill down to a lower time frame. So 5 or 15-minute charts, for example, you'll be able to see a clear setup, and that's the setup we're looking to take. So in this example, we saw price pull back to 50% retracement level, and then this level held. And as you can see, the price continued. So that's really what we're looking for. We're looking for a pullback. We're looking for a rejection at a pullback level. And then we're looking for price to first go and test the low in this case, and then move through the low to the next target. Okay, so here in this case, another downtrend example, this is Euro US dollar, 60-minute chart, 1-hour chart. As you can see, we draw our fibs from the swing high to swing low. Price came in this case, as you can see, this is a nice rejection pattern, pin bars, 2 pins here, very nice setup. So this setup is a 1-hour chart, so each candle is an hour. So you had 2 hours to find your way into this trade. So this is a very, very nice setup, especially on an hourly chart. If you see nice rejections like this at 61.8 level, and so that's what you're looking for. These are good levels, and see, it's 31. It went and tested at 3100, got rejected there. It didn't hold above the 6100. All the candle closes are below the 61.8 level percent retracement level. Those are the type of things you're looking for. So you would drill down into a small time frame and looking to enter this trade. Basically, you're looking for the first target is this here. Actually, you can have multiple targets along the way, which we'll talk about later in the presentation here. But basically, you're looking for price to come back and test the same level again. So this is an example of 61.8% retracement level being held. So here we have another chart. So we have a swing high here, very clear swing high. So this is the Euro Pound 1-hour chart. Oops. Sorry, I moved too far here. Yeah, Euro Pound 1-hour chart. So we have, and this is a recent chart. So this is not from a long time ago. This is very recent. This is in October 13th, 14th, 15th. We have a clear swing high, and we had the swing low. And as you can see, the price, one thing that I have found, this is actually a good tidbit that you may not hear everywhere. If the price holds the 23.6% retracement level, or 38.2 retracement level, the chances are very, very high that the trend is going to continue. That's a sign of a very strong trend, and you're looking for the trend to continue in the direction that the price was moving. So anytime you have, so this is this was drawn on, so you can actually, we do see the price here, but when you're here, you will basically just draw your swing high to swing low, and then you're looking for a retracement. If the price holds the 23.6 level, let's say you closed, you were this the close of the day, and the price only retraced less than 23%, and the next day the price didn't go anywhere, and the following day the price just sat below 23.6%, the chances are really, really high that it would go in the direction of the trend. And as you can see, it came to 127 extension level. So that's what we are looking for. We're looking at pullback levels and looking for extension levels as our potential target. So retracements will be the pullbacks, and extensions are where our targets would be. So again, this is another example, Euro Pound 4-hour chart. We have swing high, very clear swing high here, and then we have swing low here. This is when the price would have closed. So again, 23.6 level here, retracement level. See how the price into the close of the day, normally you would expect a higher pullback. However, if the price just sits at 23.6 level, and here you can see there's another rejection, clear rejection of this level, you're looking for another move to the downside, and you're looking at 127, 161.8, or 138, 161.8, and 200%. So as you can see, price had a reaction at 127. It got to 127, and there was a big pullback, and then it followed through and then did a back test here of the 161.8 retracement levels, and then price continued down, comes and back test this 200% level here, and then drops from there. And then as you can see, this again 200% level comes into play as well. So that's what I mean when I say these levels tend to act as dynamic support and resistance levels. And because a lot of people are looking at these levels, they're paying attention to these levels, they come into play all the time. So here's another example. This is a fairly recent chart. Actually, no, this is back in June here. Your US dollar 1-hour chart. We have a swing low and swing high. So this will be drawn when the price would close over here. So once you have an established swing low and swing high, we could even actually have pulled it all the way to this one, and that would work as well. So here, as we can see, 38.2% retracement level holds. We see a nice pin into this, really, really nice rejection of this level, stop run into this, nothing else, and all the price action is right here. So this is really good. So this is 23.6, does a pin bar into 38.2. So very nice. This suggests, even if we did not look at this here, let's say pretend this did not exist, just by looking at this pin bar, I would be expecting the price to go up, right? And the first target would be the 127%, which is right here. So this will be the first target. You're looking for a pullback out of here, and then once the price holds here, and then you're looking to get into this setup, you're looking for a setup at this place or at this place, and looking to go with the trend. You're not fighting the trend at this point. When you see this, you wait, and you wait for pullback. You check where the price is rejecting, and once you have a good confirmation on your smaller time frame that the price is being rejected at that level, you enter into the trade in the direction of the trend. So we would be entering a long position either somewhere in here or in here. Once we have seen this pin bar, we'll be looking to go long with this, expecting the trend to continue. So the first target would be the 127 extension, which is right here, and then we may have another one at 161 and another one at 200, 138, then 161, and then 200. So those are the levels, and levels would be looking for. See how here at 161.8 extension, we had a nice stop hunt, pin bar right into this level. The price went, tested this level again, but held. So this is a really nice evening star pattern. This is a reversal pattern, and we'd be looking for a short at this point because our fibs have already played out, and at this point we are done. So if you have something like this, to get out of the trade, you're looking for a reversal pattern in the opposite direction, essentially. All right, so now let's take a look at how do you use Fibonacci's with other technicals. So how do you use, excuse me, Fibonacci levels to improve your technical analysis that you're already doing? So in terms of the Fibonacci, because they are a little bit ambiguous in the sense that you can choose to put them wherever you like, and you yourself are looking for a swing high and swing low, and there can be multiple swing highs and swing lows, I use them as a confluence indicator. So I don't trade just based on Fibonacci's. I like to see other things that come together at the same level. And I use Fibonacci's as a support. I mean by as a confluence indicator. Another thing that puts the probabilities in my favor to take that trade. So let me give you some examples. For example, we have dollar Swiss daily chart here. So as you can see, we can use Fibonacci levels with support and resistance levels. So essentially, I would look for a strong support and resistance level. So just like here, for example, we have, this is my chart. Actually, I'm gonna, we can leave it here. So these are all the different fib levels. So what I'm looking for is confluence. See how I have a support level drawn at 50 to 47 here. So about the 50 level. And price, when it came at this level, it had bounced originally. So this was our fib level that we had drawn. So I'm looking for price reaction again at this level, and I'll be watching to see if this level holds. So in this case, this level held, but it never broke the low. So we know that there may be a potential larger pullback. And in this case, the price came to 50%. And then this is a 4-hour chart. So even the small moves can be worth a lot, actually. So this is 100 pip move, 93 pips in here. So that's a large enough move that you could take a trade here. So for example, we drew from here to here. So we're looking for, when you see this double bottom like this, 2 pins into the same level, but the level is not broken, you can take an entry into this candle. So you're looking for a pullback here to go upward. So you're looking for, actually, you know what, let's look the other way. So let's say the trend held, and now you're looking for a retracement level. So you can wait for the price to first come to 23.6 retracement level and see how the price reacts at this level. So we are looking for the trend to continue, we'd be looking for a rejection of this level. And as you can see, the price got here and rejected. And the second time a price came and tested this level, it got rejected again. And this was over 100 pips. So you'd go to your smaller time frame and you will look for price reaction at this level to go short in this trade. And because you have your support and resistance level here, this makes it a stronger level to find a trade at. It's another factor of confluence, another thing that's stacking the probabilities in your favor to take a short trade at this level. So the price comes here, it doesn't go any lower. See how there's a clear multiple pins into this level. It doesn't go any lower, so you want to get out once the price doesn't break below the level. So anyway, so that's the way I use support and resistance. I always have support and resistance levels on my chart. So if you see that your support and resistance level and your fibs are in the same spot or very close to each other, you want to pay attention to that area for potential trade setups. So in this example that we have here, so as you can see here, this is a nice resistance level, here, and it ends up becoming a support level. So it's 10, 50, or 1.0, 50 level. 50 levels are always good support and resistance level. So if you see a confluence, this is a 50% retracement, it's a previous swing high, it's a support and resistance level, and look at the multiple times the price rejects this level. So this is very good. So you have multiple factors telling you that price is not wanting to go any lower, and you would enter your trade in the direction of the trend. So you look to buy in here. So for example, when the price holds this level, this previous swing high and the fib level, you're looking for price to continue up. So your first target would be the 0% here, and then your second target will be the 127% extension. And then if price still continues, you're looking for the following levels to be filled. And you can also use your Fibonacci's with the trend lines. For example, let's say you have, this is a nice uptrend, you have uptrend line here, this is a 1 hour chart, and you're drawing your previous last swing low to swing high. And as you can see, there is a confluence. So your fib level, 61.8, and your trend line are in the same spot. They intersect. So this, and then you see price come and start rejecting at this level. This is a good indication that the price doesn't want to move any lower. So you have multiple factors coming together. You have your trend line, you have your 61.8 fib level, and you also have your rejection pattern. See how the price compresses into this level? The candles are getting smaller and smaller, and the price is not willing to go below this level. The candle doesn't hold, it so shows rejection. This is a good indication that the price is exhausting and wants to go higher. And as you can see, it went to the 100% level, and then it went even higher. So this is a good way to look at fibs coming together with your other technical indicators. All right, so how do we plan our trades using Fibonacci? So every night when I do my post-market review, I use Fibonacci levels as a way to look for a potential target. So at night, when you do your analysis, basically I draw my fib level. So this is an extension tool. This is what the extension tool looks like. I tend to combine my Fibonacci retracement with the extension, so I'm not using two different tools. I just like to keep things simple, so I like to use both of them all at once here. So this one is a real extension. So you're looking for swing low to swing high. So you're looking for a pullback, essentially. So the following day, you're looking for where could the pullback potentially come to. So you would have your different levels drawn here for the pullback, and then what are your targets? So with this extension tool, you can plot your different targets. So the first target would be your the same high. So you're expecting for the price to go and test the high, and then you're looking for the price to go up, go above your high, and then start going upwards. Basically, your fib levels become the levels you're looking to take profit. For example, let's go back to our chart here. So this was our level. So the price pulled back. There were different pullback levels. So once the price goes through here, so when, let's say we're looking for, this is a good level. As you can see, this is the 5,500 level. Price doesn't seem like it wants to break this level. So you would look for our 78.9 is actually, it's not too far, but it's a 4-hour chart. So actually that doesn't come into play. So here, 61.8, see how we have multiple rejections? So this is your evening star pattern. This is a reversal pattern. So you're looking for price to come down. So if you get your reversal pattern here at 61.8, and then you have these different pins going into this level at 61.8%. And see how they're rejecting. There are different pins you're rejecting. So that's a nice rejection. And this is a confirmation candle. So you can enter into trade after this pin, or go to a smaller time frame. I suggest going to a smaller time frame on your 1 hour, 15-minute, or 5-minute chart, and you're looking for an entry, and you will see an entry here. Actually, let's take a look at it. So November 3rd to 6th. So we will go back to, let's go into a 15-minute chart. Let's pull it up, see if we can see. Oops, we were on, yeah. So these are our different candlesticks. This is, let's go to the latest price action. So here we go. So these are our fib levels, the 61.8 fib level. So this is what I mean. See how the price comes and it goes to this level, 61.8, and it rejects. There's a nice pin into this, and then price comes back, tries to go up again. It starts making higher lower highs. So we know that the price is basically failing. So you're looking for a pullback into this, for example. And here's another thing. If you're using trend line, so I have a trend line here. This is, let's say, not trend line, moving average. So I have a 14-period moving average here. See how the price is rejecting on the moving average? So this is another factor of confluence. It's an important level that the price is, or it's being held by your moving average. It's an important level. So if you take at this level, I believe a 45, so 50 level tends to be a good level. So price rejecting 61.8. So they have 3 different things coming into play here. And you can get into trade somewhere in here, because if you look at these candles, they are actually, see nice pin bar into this. Oh, that's not here. So we have nice pin bar, rejection, pullback again, rejection here. So you can get into trade somewhere in here even, and looking for a trade here. You have 53 pip move, but the entire move here, this is actually non-farm payroll. So you may, is it that non-farm payroll? No, that's not non-farm payroll. That's another news event. So basically you can enter into trade here. Even this trade itself is over 50 pips. So that's not a bad trade. So basically you're looking from one level to the next to take your profit. So you would be looking for a trade entry into here somewhere, and you're looking at the next level to take your profit. So you could get in either with your 40 pips into here somewhere, or you can hold on. And in this case, there was news coming out. So normally I suggest not to trade the news. However, from a Fibonacci perspective, it holds the 50% retracement level and comes back into the following level. So there's so in terms of your trade setups, you're looking for rejections, pins here, and as you can see, it starts making lower highs, which is good for our trade setup. So let's go back to the chart. So any questions at this point? Does this make sense? All right, so let's continue on. We have take profit levels we just talked about. You will look to place a trade at your pullback or your retracement levels, and then you are looking at the different targets for places to. So you're looking for the next level to take your targets, your profit target. Each next level, let's say you took it at 61.8%, so 50% becomes your target, and each next level becomes your target for taking profit. All right, any questions before we wrap it up? So the bottom line is, when it comes to planning your trades with the Fibonacci's, you're looking for pullback levels to enter the trade, and you're looking for extension levels or the next pullback levels, next fib level to get out of the trade to take your profits. Okay, so that's all I have for today. So we will call it a wrap. You guys have a great day and a great trading week. I will see you next time.